Silver just jumped 12% overnight, from $76.50 yesterday to $86.58 this morning. Futures reclaimed key resistance. Technical analysts are calling the bottom. The headlines say recovery, but here's what they're not telling you. While COMEX bounced to $86, Shanghai is still trading at $130, a $44 premium. That's 51% above paper prices. After the biggest single-day recovery since the crash, the disconnect didn't close. It widened. This isn't a normal bounce, and the data proves what's really happening. Let me show you the exact numbers. Silver February futures closed yesterday at $76.50. Asian markets opened overnight at $83.25, up 8.8% before U.S. markets even woke up. By morning, silver hit an intraday high of $86.58, a 12.43% move from yesterday's close. Current price, as of this recording, $87.47 according to Trading Economics. That's a $10.97 gain in less than 24 hours. The fastest recovery we've seen since the January 30th crash, when silver lost 31% in one day. Here's where it gets interesting. COMEX spot silver, 87. Shanghai physical silver, approximately $130 based on the latest reports from multiple sources. That's a $43 premium, or 49.4% above COMEX. 2 days ago, when COMEX was at $72, Shanghai was at $102, a $30 premium. Yesterday, COMEX was $76, Shanghai $115, a $39 premium. Today, COMEX $87, Shanghai $130, a $43 premium. The premium isn't compressing during the rally, it's expanding. That tells you everything about what's really happening in the physical market. Let me break down what a premium means. In normal markets, Shanghai silver trades $2 to $4 above COMEX due to shipping, insurance, and import costs. Right now, we're seeing a $43 premium. That's 11 times normal. When was the last time we saw premiums this high? Never in modern history outside of the 1980 Hunt Brothers squeeze and the 2011 manipulation events. Both times, it signaled a structural breakdown between paper and physical markets. Both times, it ended with either defaults or exchange rule changes. We're seeing the same pattern now. Physical retail premiums in the United States tell the same story. I checked 3 major dealers this morning. APMEX, Silver Eagles selling at $98.60. That's $11.13 over the $87.47 spot price. JM Bullion, generic silver rounds at $97.90, a $10.43 premium. SD Bullion published a report 48 hours ago stating physical demand surged 250% during the crash. Delivery times haven't improved, still 3 to 6 weeks for most products. If this was just a technical bounce with no underlying shortage, premiums would be dropping and dealers would have inventory. They don't. Now let's talk about what triggered this 12% overnight move. On the technical side, silver found support at $72.80. Friday, which was the 2020 COVID crash, low adjusted for inflation. That level held on multiple retests over the weekend. Asian buyers stepped in aggressively Sunday night. Volume on the February contract was 47,000 contracts in the first hour of Asian trading alone. That's 235 million ounces of paper silver changing hands. For context, global annual mine production is about 1 billion ounces. In 1 hour, 23.5% of annual production traded on paper. But here's the part everyone's missing. While paper volume exploded, physical withdrawals from COMEX vaults continued. According to the latest data from CME delivery reports, registered silver inventory stands at approximately 105 to 113 million ounces, depending on which source you check. That's down from 415 million ounces in September 2025, a 74% decline in 5 months. On January 7th alone, 3.25 million ounces were withdrawn with zero deposits. That's not normal market behavior. That's a run on physical metal. Let me show you the delivery pressure building. February 2026 contracts saw 633 delivery notices issued on first notice day, January 29th. That's 3.165 million ounces called for physical delivery. But here's what's unusual. Traders are rolling contracts backward from March into February and January. Normally, traders roll forward to avoid delivery and maintain futures exposure. Rolling backward means they want metal now, not later. In the first week of January, 3,000 contracts rolled backward. That's 15 million ounces of immediate demand. This only happens when traders believe they won't be able to get metal in future months. There's a leaked video from 3 days ago discussing internal emails between vault operators and exchange officials about March delivery concerns. I can't verify the authenticity, but the pattern matches what we're seeing in the data. Open interest in March contracts is elevated, while registered inventory keeps falling. Do the math. If March deliveries match February's pace and inventory continues draining at current rates, COMEX could face a supply crisis by April. Not speculation, basic arithmetic. Now let's address the elephant in the room. Is this the real bottom or a bull trap? I'm going to give you 3 scenarios with probability estimates based on the data. Scenario 1, technical consolidation. Probability 45%. In this scenario, silver bounces to $91, which was support before the crash and is now resistance. It fails to break through cleanly and retests the $80 to $85 range over the next week. Shanghai premium compresses to $15 to $20 as some physical buyers take profits. This would be a classic dead cat bounce followed by consolidation before the next move. The pattern would look like a flag or pennant on the daily chart, which is continuation pattern. For this scenario to play out, we need to see a few things. First, volume needs to decrease as price approaches $91. Second, Shanghai premium needs to start compressing by at least 30%. Third, COMEX inventory withdrawals need to slow to under 1 million ounces per day. And fourth, retail premiums in the US need to drop back towards $6 to $8 over spot. If those 4 things happen, we're looking at consolidation, not continuation. That would set up a retest of lows or a multi-week base building phase before the next leg. Scenario 2, V-bottom recovery, probability 35%. Silver breaks cleanly through $91 this week on strong volume. Shanghai premium stays elevated above $30. COMEX inventory drain accelerates. Target $100 by February 10th to 15th. This would confirm the crash was purely technical liquidation and the fundamentals remain bullish. In this scenario, the $72 low becomes a generational buying opportunity that won't be seen again this cycle. Bulls who bought the dip get validated. Bears who sold the crash get squeezed covering shorts. For this scenario, watch for these signals. Break above $91 with volume exceeding 200,000 contracts. That would confirm institutional buying, not just retail. Shanghai premium maintaining $25 to $35 range, even as COMEX rises. That proves physical demand is price inelastic. COMEX registered inventory falling below 100 million ounces this week. And finally, any news of delivery delays or force majeure clauses being invoked. That would be the smoking gun that physical shortage is forcing price discovery. Scenario 3, March delivery crisis. Probability 20%. This is the wild card. Silver bounces to $80 to $90, then stalls. But behind the scenes, March contract holders demand delivery in unprecedented numbers. COMEX is forced to either deliver metal that doesn't exist, invoke cash settlement clauses, or change the rules mid-game. Price gaps up 20% to 30% overnight when the squeeze becomes public knowledge. Target $110 to $120 on the initial spike. This is low probability but high impact. It's what happened in nickel on the London Metal Exchange in 2022 when physical shortage met paper leverage. The warning signs would be subtle. Watch for any COMEX rule change announcements, especially regarding delivery procedures or cash settlement options. Monitor vault-to-vault transfers increasing, which indicates scrambling to find deliverable metal. Check if any major banks or trading firms get exempted from delivery obligations. And watch for mainstream media suddenly publishing articles about silver shortages or delivery problems. When CNBC or Bloomberg start covering delivery issues, it's already too late to position. The move happens in the derivatives market first, then the media reports it after. Here's what I'm watching this week to determine which scenario unfolds. First, the $91 level. Silver tried to reclaim this level twice in Asian trading overnight and got rejected both times. It's currently sitting at $87.47 baht. That's $3.50 below the key resistance. If we close above $91 on strong volume by Friday, the V-bottom scenario becomes more likely. If we get rejected again with decreasing volume, consolidation is more likely. If we gap through $91 on Monday opening, the squeeze scenario enters play. Second, Shanghai premium direction. Check silver prices on Shanghai Futures Exchange every morning. If the premium compresses below $30, physical buyers are satisfied with COMEX catching up. If it stays above $40 or widens further, physical shortage is worsening despite paper price recovery. The premium is the single best real-time indicator of physical market stress. It doesn't lie because it represents actual transactions, not paper contracts. Third, COMEX inventory data. CME publishes daily vault reports. I'll be watching for 2 things: total registered ounces and net daily change. If we see another 3 million ounce withdrawal day like January 7th, that's a red flag. If we see deposits exceeding withdrawals, that signals some supply is returning to the market. The cumulative withdrawal rate over the next 7 days will tell us if the drain is accelerating or stabilizing. Fourth, dealer premiums and availability. Check APMEX, JM Bullion, and SD Bullion every day. If premiums drop below $8 and delivery times shorten to under 2 weeks, physical supply is improving. If premiums stay above $10 and delivery times extend beyond 6 weeks, the retail squeeze continues. Dealers are the canary in the coal mine. They see physical supply stress before it shows up in COMEX data. Right now, there's screaming shortage. Let me give you the actionable trading plan based on your position. If you're actively trading futures or leveraged ETFs, here's the setup. Long entry above $82 with a stop loss at $70. That's a 4.6% risk. First target $91, which is a 5.7% gain from current price. Risk reward ratio is 1.24 to 1. Not amazing, but acceptable given the volatility. If $91 breaks, trail your stop to $88 and target $100. That becomes a 9% risk for 15% reward. Much better risk reward on the continuation. If you got stopped out during the crash, don't revenge trade. Wait for a clear setup. That means a daily close above $91 with volume confirmation before re-entering. Or wait for a retest of $80 to $82 if we get consolidation. The worst thing you can do in volatile markets is chase. Let the price come to your level. If it doesn't, the next setup will. There's always another trade. For those holding physical silver, do nothing. Your metal didn't lose value just because paper price crashed 40%. Industrial demand for silver hasn't changed. Solar panels still need 100 million ounces per year. Electronics still need silver. 5G infrastructure still needs silver. The fundamentals didn't change. What changed was leverage ratios on paper contracts and margin requirements. That has zero impact on the long-term value of physical metal in your possession. If you're looking to add physical silver, understand what you're actually paying. COMEX spot is $87.47, but you can't buy an ounce anywhere near that price. APMEX is quoting $98.60 for Silver Eagles. That's your real price. $11.13 premium or 12.7% over spot. If premiums drop below $8, that's a better entry. If you're a long-term stacker and don't care about timing, dollar cost average in. Buy a fixed dollar amount every week regardless of price. Over years, this smooths out volatility. But don't go all in at current levels with elevated premiums unless you believe we're heading into scenario 3. Here are my 3 key takeaways. 1. The 12% overnight bounce is technically significant but not yet confirmed as a trend reversal. We need a close above $91 to confirm bulls are back in control. Until then, this could be a bounce within a larger downtrend. Don't confuse a relief rally with a bull market resumption. 2. The Shanghai premium staying elevated at $43 despite COMEX rising 12% proves physical demand is real and growing. This is not a technical indicator. This is actual metal changing hands at massive premiums. It can't be faked or manipulated. It's ground truth. 3. The March delivery squeeze is building pressure behind the scenes. Whether it results in a crisis depends on how many contract holders actually stand for delivery versus rolling or closing positions. Based on the backward roll data, more traders want metal now than in any period I've tracked. That's either the setup for the mother of all short squeezes, or it's going to force COMEX to change the rules. Either outcome is historic. Make sure you understand your exposure and risk tolerance before these events unfold. My personal position: I hold physical silver with zero leverage and I'm not selling any. I took profits on 30% of my trading position at $98 before the crash, which I disclosed in my last video. I'm looking to re-enter that 30% if we get a confirmed break above $91 with my stop at $88. That gives me a $3 risk for a potential $9 to $13 gain if we target $100. I'm not buying more physical until retail premiums compress below $8 or I become convinced scenario 3 is unfolding, in which case premiums don't matter. The next 72 hours are critical. By Friday, we'll know if this is a genuine bottom or a bull trap. By next week, we'll know if the March squeeze is real or just speculation. And by month end, we'll know if Shanghai premium was a temporary dislocation or a permanent decoupling of paper and physical markets. I'll be updating daily as this story develops. If you found this analysis valuable, hit the like button. Subscribe for daily market coverage during this volatility. Share this with anyone holding silver who needs to understand what's happening. Drop a comment below. Are you buying this bounce or waiting for a retest lower? What's your take on the Shanghai premium? Is this the bottom or a trap? I want to hear your perspective. Follow me on X for real-time updates as data comes in throughout the week. I'm posting charts and breaking news between videos. Tomorrow's video will cover the Asian session tonight and whether we see follow-through buying or rejection at resistance. Upload time 10 p.m. Pakistan time. Don't miss it. Final disclaimer, this video contains my personal market analysis and opinions based on publicly available data. This is not financial advice. This is not a recommendation to buy or sell any security or commodity. You must do your own research. Verify every number I've stated. Consult a licensed financial advisor. Never invest money you cannot afford to lose completely. I may hold positions in the markets I discuss. Understand your personal risk tolerance before taking any action. Silver is volatile. This volatility can result in complete loss of capital. Trade and invest accordingly. Until tomorrow, stay sharp. Markets don't wait for anyone. See you in the next one.